Welcome to GRE. I'm your host, Keith Weinhold. Home prices aren't really up. Brace yourself. A mic drop moment on real estate costs is coming. It's an unmasking, a reality check on property prices. Are homes actually still priced too low today? How could that possibly be true at all on Get Rich Education?
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. From Belgrade, Serbia to Belleville, Illinois, and across 188 nations worldwide, I'm Keith Weinhold, and you're listening to episode 501 of Get Rich Education. We'll get to the question, are homes overpriced or underpriced today shortly, but understand this. I successfully acquired something at a young age, and you can too. That thing that I successfully got a hold of was not millions of dollars, because I came from average means. What I intentionally and successfully acquired was millions of dollars in debt. Yes, obtaining millions in debt from a young age is what led me to quitting my day job while I was young enough to enjoy it. You, the longtime listener, completely understand and appreciate what I just said. If you're a newer listener, that sounds unusual for sure, maybe even irresponsible. Well, come along for the ride. Also, a layperson or a newer listener would respond to that with something like, no one talks that way, thinks that way, or does that, taking out millions in debt and calling that aspirational. Remember, we don't want to be like most people and think how most people think if we want to have an outsized result. Using that debt as leverage is how you ethically take funds from the big banks. You take Chase Bank's money. You take Bank of America's money. You take it from Wells Fargo. Learn how to use it. Be a responsible steward of the funds. Provide good housing for people and prosper. That means you get a return on both your down payment and the entire amount that you borrowed from those banks. That all goes to you. And what about that debt? Oh, well, both your tenants and inflation pay it back, not you. Look, I know one person. I personally know a guy. His name's Greg. Greg makes $80,000 a year from his day job. He's a good guy, married guy, one kid, and his net worth increased by $2 million just in the COVID run-up. He has a modest salary, but his net worth is up $2 million just since 2020. And now, first of all, do you think that any of Greg's co-workers experienced that effect? No, he's really going down my path. Greg, is soon going to get unrelatable to his co-workers and even some of his peers. Well, what makes it possible for a good family guy or anybody to go from a middling salary to obtaining life-changing wealth? It takes leveraged. He borrowed for bank loans. That way he could acquire 5 times as much property than if he had paid all cash for that portfolio. See, that way he had 5 times as many properties, and properties all appreciate at the same rate regardless of how much equity you have in them. See, if Greg had paid all cash instead right up front, he'd only have a $400K capital gain plus or minus. Not bad, but $2 million is life-changing thanks to leverage. Everyday people obtain life-changing wealth this way, and it's so substantial that it won't only affect Greg's life. If he continues on this way, it'll take care of his children and grandchildren and great-grandchildren. And maybe this is why one of the most recurrent guests here that we've had in the history of GRE, Ken McElroy, he says, the best investment in real estate is the one that appreciates the most, not the one that cash flows the most. That's Ken McElroy, and now you can see why he says that with that example that I just gave with Greg. Leverage appreciation creates wealth the fastest. Cash flow is important, and it can boost wealth, but that happens more slowly. Principal paydown doesn't create wealth, it enhances it, and it's the same with tax benefits. Inflation profiting can really help propel your wealth. Deferring your tax on a 1031, that basically means that you can re-leverage a greater amount without tax taking its portion. Low interest rates also don't create wealth. In fact, I bought my first ever income property with a 6 3/8% mortgage rate. I think I've shared that with you. And my second income property, that had a 7 5/8% mortgage interest rate on it. And that second one had interest-only payments. But I borrowed basically the maximum amount that I could without over-leveraging. Over-leverage means you've lost control of the mortgage and operating expenses. The lesson here is get the leverage. And case in point, here we go. What's happening today? Speaking of appreciation, the latest Case-Shiller Home Price Index figure came in, and the U.S. currently has 6.4% year-over-year home price appreciation. Now, their index is only based on 20 cities, but that gives you a pretty good idea. In fact, that is the fastest rate of increase since 2022. And a lot of people think when mortgage rates fall, home appreciation rates can increase from there. But now look, if you'd let equity build up in your properties this past year, say, to the point that they're half paid off, well, then you only had 2 times leverage. All right, well, what that means today is that 6.4 appreciation, that gave you just a 12.8% leverage return on your skin in the game. Not too bad, though. And of course, if you instead leveraged with a 20% down payment a year ago, giving you 5x leverage, all right, well, that appreciation rate of 6.4%, we'll multiply that by 5. You just got a 32% return in the past 12 months. And as we know, all these returns I just told you about are from one of just 5 ways that you're expected to be paid simultaneously. But yeah, a 6.4% higher price, that is merely a dollar-denominated price. That's what that is. Now, why do I say that so carefully? A dollar-denominated price? Well, there are a few reasons that home prices are 6.4% higher. Inflation from dollar printing could be why. The value, not the price, but the value of some properties are increased, and that is distinctly separate from inflation. All right, what's the distinction there? How does this happen exactly? Like, what is one difference between an inflated price and a greater value? Well, say that a local economy is hot because there are more high-paying jobs there now than there were last year. Say there's been an influx of medical jobs or AI jobs or chip-making employment. Well, even absent inflation, a property that now has proximity to better-paying jobs, well, that's now a property that's more desirable. So someone is more willing to pay more for it, and they simply can pay more for it. They have a greater capacity to pay if they have one of those high-paying jobs. And again, that particular phenomenon is absent of inflation. That will occur even if inflation were zero. All right, well, what's another reason that home prices rise and rose 6.4% year over year in this case? It is better physical amenities that are in new homes, better ones than there used to be, say bigger garages or new communities with pickleball courts or whatever it is. People are more willing to pay a greater price for those things. So to review, there are 3 reasons that home prices go higher. Inflation. Secondly is appreciation from value creation, like how the same home is now located closer to more high-paying jobs. And then thirdly, better built-in amenities. All 3 of those increase the dollar-denominated price or the value. They all increase the nominal price. All right, now let's get into this whole fact that home prices aren't really up. I've covered this with you before a little bit, but I'm going to go deeper today and give you the most comprehensive look at home prices today compared to the past, perhaps than you've ever had in your life. Now, some might say, oh, come on, how can this be? Homes cost perhaps 40% more than they did just 4 years ago. Well, I've got a mic drop moment coming. Home prices aren't really up. All right, we need a good measuring stick to see what home prices are doing. So we've got to stop pricing homes in dollars for a minute. It's a poor long-term value measure. Ludicrous inflation means the dollar has lost over 25% of its value just since 2020, and the dollar has lost 97% of its value in the last century. Let's use a commodity and a money that has been valued for 5 millennia. I think you already know what I'm going to say. And its physical properties have not changed one bit in all that time. And it's valued across continents and cultures. Understand, that's 50 centuries of enduring value. Of course, I'm talking about gold. Now, we're going to get to a more modern measure soon, but first, gold is the best one. And now, I don't know who to credit here, but for a while, there was an image floating around out there that GRE got a hold of. It showed that 10 kilos of gold would buy you an average home in 1920, and also that 10 kilos of gold will still buy you an average home today. Total mic drop moment. Wow! Is there any better evidence that home prices are not up, but higher prices reflect that the dollar is down? And actually, yes, there is a little better evidence. We ran the numbers in here inspired by that image, and we learned that it's actually even more astounding than that. You run how many dollars per ounce gold is worth, and that 35-ish ounces are in a kilo, and you look at home prices of $6,300 back in 1920 and the home prices now, and we discovered that it's even more of a jaw dropper because in 1920, which I'll just call that a century ago, you could buy an average home for 8 kilos of gold, and today you can buy an average home for just 6 kilos of gold. Wow! So if you want to know how much home prices have changed in the last century, they are down 25%. They're 25% cheaper today in terms of gold. Clearly a more stable value indicator than horrendously diluted dollars are. And also in here at GRE, we made a new image that shows that 8 kilos for an average home a century ago and just 6 today. And I sent you that image in our newsletter about 10 days ago. So you have that, and that image got shared a lot of times. Well, your first reaction to this whole thing could be, wow, that is wild. The dollar really is so diluted. All right, what about home prices in terms of a popular nascent asset that only arrived on the scene 15 years ago, Bitcoin? All right, in 2016, the average home cost $288K or 664 Bitcoins. In 2020, the average home cost was up to $329K, but that was down to 45 Bitcoins. And this year, today, the average home cost is about $435K or just 7 Bitcoins. So 8 years ago, a home cost 664 Bitcoins. Today, it only costs 7. That means that home prices are down 25% in terms of gold in the last century, but they're down 99% in Bitcoin just over the last 8 years. And the dropped mic keeps reverberating through the stadium. Today's homes are cheaper in gold and drastically cheaper in Bitcoin. See, it takes real-world resources and proof of work to create real estate, gold, and Bitcoin, and none of these things are required to produce a dollar. None of them, and that's why the dollar's value keeps approaching zero. All right, that might have been your first response, like, wow, that's remarkable. But let's go deeper. You need more answers. You're part of a really intelligent audience here, because you might be thinking, wait a second. Some other things have changed too. For real people, everyday people, aren't home prices more out of reach than they used to be? That's because since 1920, home prices have risen faster than incomes have. Well, that puts them out of reach for more people. And something else has changed. A home's lot size is smaller today too. The land that comes with the property has a smaller area today on average. And let's understand too that homes also use some cheaper materials in them today. Some better ones too, but they do use some cheaper materials. For example, heavy milled raw wood doors, the interior doors of yesteryear, the bedroom door, the bathroom door, the laundry room door. Those interior doors of yesteryear, they've given way to molded particle board today. So this is beginning to build the case, evidence that homes should be cheaper than they are today. Let's keep going because there's more to consider. Mortgage rates themselves, just rates in isolation, they don't put homes out of reach at all, because the long-term average is 7.7% per Freddie Mac on the 30-year fixed-rate mortgage. That average goes back to 1971 when they first began tracking them. And by the way, many economists and analysts and others, they deem the Freddie Mac data to be the most reliable historic data when you go back decades. All right, so mortgage rates are normal. Oppositely here now, you can make the case that U.S. homes should cost even more than they do today. In a lot of advanced nations, homes are way more pricey than they are in the United States. Even next door in Canada, they cost about 20% more than U.S. homes do, and Canadian salaries are lower than U.S. salaries too, even while their home prices are markedly higher in Canada. Now, on some levels, you're getting more home today in the U.S. I mean, a 1920 home, that would feel savagely uninhabitable to you if you tried to live in one of those now. And here's what I mean. In 1920, 1% of homes had electricity and full plumbing. Today, 99% of homes have electricity and full plumbing. What I mean then, by savagely uninhabitable, is, hey, go ahead and enjoy walking to the outhouse in the middle of the night in the dark when it's 35 degrees, okay? And then there's size. About a century ago, 1920, the average home had 242 square feet per person, and today the average home has 721 square feet per person, 3 times more size per person, because today family sizes are smaller and homes are way larger as well. And today's amenities inside the home and around the home, they would just be unthinkable in 1920. Walk-in closets, roofs with R38 insulation, double-pane thermal windows, smart thermostats, voice-controlled lighting, quartz countertops, a good KitchenAid appliances, maybe even a security system comes with the home. Those are all things that homes have today. And gosh, it doesn't even have to be that aspirational. I mean, even the fact that you have a garage, a heated garage even, things like a finished basement, an air conditioner, a modern washer dryer, that would leave 1920 homeowners dumbstruck with their mouth agape, mouth wide open, maybe even flabbergasted. Those old folks from yesteryear, they wouldn't believe all that you get with a home today. Yet that 1920 home still would have cost you more in gold than today's more sizable homes with all other plush amenities. Now, when it comes to, though home prices aren't really up, are they more out of reach for the average American? Over the past 5 years, they are, because home prices have now risen faster than incomes over that stretch. But another big reason that homes are substantially more affordable today than they were in 1920, and this is huge, is financing terms. Today, you can make a down payment for between 3% and 20% on a home. Do you know what loan terms were like in 1920? You had to make a 50% down payment, and then you had to pay off your mortgage in 5 years after making half of the property's value in a down payment. I mean, can you imagine if that were the case today? How many people could put 50% down on a home today and then pay off the balance, the remainder, within 5 years? Virtually nobody. That's why homes are more within one's grasp today. So overall here, on balance, you can see that there are a lot of countervailing factors tempering that it took 8 kilos of gold to buy a home a century ago, and it only takes 6 of them today. The bottom line here is that long-term real home prices are not up, dollars are down because they've been printed like crazy. And from today, nominal home prices could keep rising for years. A lot of people think that the appreciation rate is going to rise once interest rates fall. And on that image that we posted about the 8 kilos of gold versus 6 kilos of gold today to buy a home, Dustin on social had a funny comment about this. He wrote, "How many Baconators from Wendy's would it take to buy a home today?" I don't know. I guess that's a hamburger. I don't go to Wendy's. Maybe then a home costs 60,000 Baconators today. There you go. Coming up straight ahead, what will happen first? A $750K median home price, $100K Bitcoin, or $5K gold? Also, what's perhaps the biggest trend in real estate investing that not enough people are talking about, and how you can make money from it, and more? All next. I'm Keith Weinhold. You're listening to Get Rich Education. For a lender that's a specific expert with income property, you need Ridge Lending Group, NMLS 42056. In GRE history, from beginners to veterans, they provided our listeners with more mortgages than anyone. It's where I get my own loans for single-family rentals up to 4plexes. Start your pre-qualification and chat with President Chaley Ridge personally. They'll even customize a plan tailored to you for growing your portfolio. Start at ridgelendinggroup.com. ridgelendinggroup.com. You know, I'll just tell you, for the most passive part of my real estate investing, personally, I put my own dollars with Freedom Family Investments because their funds pay me a stream of regular cash flow, and returns are better than a bank savings account, up to 12%. Their minimums are as low as $25K. You don't even need to be accredited for some of them. It's all backed by real estate, and I kind of love how the tax benefit of doing this can offset capital gains and your W-2 job's income. And they've always given me exactly their stated return, paid on time, so it's steady income, no surprises, while I'm sleeping or just doing the things I love. For a little insider tip, I've invested in their Power Fund. To get going on that, text FAMILY to 66866. Oh, and this isn't a solicitation. If you want to invest where I do, just go ahead and text FAMILY to 66866.
This is GRE Real Estate Investment Coach Naresh Vissa. Listen to Get Rich Education with Keith Weinhold, and don't quit your daydream.
Welcome back to Get Rich Education. I'm your host, Keith Weinhold. On our latest GRE social media poll, we ran this question. Which of these three things do you think will happen first? The median home value hits $750K, Bitcoin to $100K, or gold hits $5K? Well, the results across both LinkedIn and Instagram were pretty similar. Sometimes you get differences among certain platforms, like LinkedIn is a more professional audience. And one voter in the poll also commented, it's syndication attorney Mauricio Raul, who we've had here on the show before. Mauricio says, I think assuming Bitcoin doesn't collapse, it probably makes a run to 100K in the next few years, but who knows, it could be the next few months. He goes on to write, but with the median home at 10% appreciation a year, it would take 6 years for it to hit 750K. So that is a decade away. All right, those are Mauricio's thoughts. That sounds reasonable. And the poll result is Bitcoin will hit 100K first. That was deemed as the most likely thing to happen, with 57% of you answering that. And that makes sense since it's volatile and it's close to striking distance there. The median home value will hit 750K. That finished second. 26% of you said that. And gold up to a 5K price, that got just 17% of the vote. And that makes sense since gold prices would have to about double from here. And you can always join along in the conversation in polls. We are really easy to find because on virtually every social platform, Facebook, Instagram, LinkedIn, YouTube, we are Get Rich Education. And over on the Get Rich Education YouTube channel, I recently covered how the Fed is overseeing a tug of war between inflation and a recession. And they don't want the tug of war game to end. So the Fed is trying to keep the game going. So I was over there the other day trying to help you understand how the Fed works with that analogy. The Fed doesn't want participants on either side of the tug of war falling into a pit. These two sides pulling the rope, inflation on one side, recession on the other side. The Fed does not want either side to win, because if one side wins, either inflation or a recession, well then the Fed and the public lose. So you can see a video about that on our YouTube channel where you get the visual tug of war game between inflation and a recession. That's just one example of how that content is often different from what you're hearing now. So get more on our YouTube channel, again, called Get Rich Education. The homeownership rate just fell again a little quarter over quarter, increasing the number of renters and the rental demand, and that's a trend I expect is only going to continue. From CNBC, Realtor.com's chief economist Danielle Hale, she tells us more. Let's listen in. It's about why the housing market is pretty dire for young Americans. Then I'll be right back with some key commentary on this.
Young homebuyers are extremely negative on the availability of housing in the country at this point, with 68% calling it non-affordable and only 6% of young Americans saying that housing was both available and affordable, according to CNBC's latest Generation Lab poll. Joining us right now is Danielle Hale, Realtor.com's chief economist. And Danielle, I have to say, it's not surprising to hear this from this group of them because the numbers are pretty horrific. I couldn't believe how much money you need to make in the top 10 markets to be able to find housing. And it's not unique to just those top 10 markets. What's happening?
Yeah, so this isn't a new phenomenon. We've been talking about the undersupply of housing for the better part of the last decade. We can see that relative to pre-pandemic levels, housing is down 36% when we look at the for sale market. So there are 36% fewer homes for sale, and home prices have gone up by about a similar margin, 36%, combined with higher mortgage rates that buyers are facing right now. Those higher prices mean you need to earn over $100,000 in 34 out of the 50 largest metro markets to buy the typical home for sale. So we're not talking luxury properties. We're talking just the median home that's available for sale today.
If you look at the top of the list in terms of most expensive, most of them in California. San Jose, you've got to make $361,000. LA, it's almost $300,000. San Diego, almost $260,000. And then San Francisco. I mean, that is pricing out an entire generation from this housing market.
Yeah, I think that's true. We don't see very many first-time buyers in these markets because they are well-established markets where prices are very high. If you look at the calculation of what it costs to buy, it takes over $250,000 to buy a home versus what it costs to rent. It's expensive, but not as expensive as it is to buy. And so many are making that decision in these large markets to rent. That's why we see home ownership rates in these large markets trail behind the typical U.S. housing market. So it is challenging in these markets. But even though it is a pretty challenging market, there are some areas where we do see opportunities, in particular in the Midwest and in the South, where home prices remain relatively more affordable. And although it is a dire situation if you compare to 4 years ago, where we're looking at much fewer homes on the market, compared to last year, we are seeing an increase, and a significant one. Homes on the market for sale are up over 30% compared to a year ago. And if we look at the below median price point of $200,000 to $350,000, homes in that price category are up by 40%. So we are starting to see a bit of a turnaround, a bit of improvement, but from what is still a pretty dire situation for young people.
But you think that's where the logjam is starting to break at the entry-level housing, and that's maybe because those people who live in those homes have finally outgrown them and they can't put off kind of either moving up or moving out?
Potentially. So we don't have a lot of detail on who is listing those $200,000 to $350,000 homes, but we are seeing more of them, particularly in the South. So that is starting to turn things around and give shoppers on the market more opportunity. That said, as long as mortgage rates remain high, it is still going to be challenging for young people to navigate even those somewhat more affordable options. And I should also note, on a price per square foot basis, we're not necessarily seeing prices come down, but we're seeing a bit of a shift in what's for sale. So that is good news for someone looking for an entry-level home. They are seeing more availability in those more affordable price tiers, but it's still relatively expensive. Fortunately, we've talked a lot about the price of housing going up. We have also seen incomes go up. So that has been one bright spot. And in fact, over the last couple of months, we've seen incomes catch up and grow faster than the cost of buying a home. A lot depends on what happens with mortgage rates here, because it does mediate the buying power of households. But as incomes catch up, home prices can essentially move sideways and give incomes an opportunity to catch up and improve the affordability picture. But it's really going to be a twofold approach. We're going to need to see more construction in order to really make a break.
Danielle, what if interest rates actually went up from here? That's not the expectation, at least for conventional wisdom. But if interest rates went up, what do you think the impact would be?
I think if interest rates go up, it's going to be harder to buy a home. It's interesting to note that that affects sellers as much as it does buyers, and so we tend to see inventory pull back when interest rates move higher, which can make it even more challenging for those first-time buyers. First-time buyers are actually still generally willing to engage with the market when interest rates go up, because they're usually at a stage in their life where they're ready to make that decision of becoming a homeowner, and they're not necessarily locked into a low existing mortgage rate. So they're more willing to engage with the market, but it does become more challenging from a pure numbers perspective and looking at qualification ratios. It's harder for them to get into the market when mortgage rates go up. But I will say that is not my expectation. I do think we're going to see inflation eventually relent and mortgage rates come down.
Yeah, there in economist Danielle Hale's interview, if mortgage rates go higher, inventory pulls back and we tend to see more modest home price appreciation. And most agree that if mortgage rates go lower, we'll see rapid home price appreciation. She also just keeps exposing what we all know: we need to build more housing. A brand new home constructed with a renter in mind and then bought by an investor, that is known as build to rent housing. You'll see it abbreviated BTR sometimes. It's usually single family homes, and some abbreviated B2R. These must be the same people that say H2O instead of water. But build to rent has become massively popular. Despite an overall housing shortage that we are in now and will be for years, well, last year, a record 27,500 build-to-rent homes were completed in the U.S., and that's up 75% from the prior year, and it's up an astounding 307% since pre-pandemic deliveries back in 2019. Okay, so these new construction homes built with the renter in mind, what is driving this build-to-rent trend? Well, locked into low mortgage rates, existing homeowners, they won't sell. So instead, new inventory has got to be constructed. That inventory has got to come from somewhere. The other thing that's driving the trend is just more overall housing demand than there is supply. Also, wannabe first-time homebuyers, they cannot afford homes today. The home ownership rate has ticked down a little bit in the past 6 months. Well, for those people, then renting a build-to-rent home is the next best thing for those people shut out of home buying. And national build-to-rent occupancy is over 96%. So build-to-rent, it operates similarly to apartment buildings under property management, but yet what they offer residents are a single-family living experience. And some of these communities have leasing offices and a community pool and fitness center. And the build-to-rent homes themselves, they often have fairly luxurious modern finishes, garages, expect a fenced backyard a lot of the time. All right, well, what about investors? What's in it for you? How do you make money with this build-to-rent trend? Well, first of all, 5% mortgage rates. I'll get back to that in a minute. Yes, if you're listening a few years from now, we're here in an area where mortgage rates are over 7% for owner-occupied. You might pay something closer to 8% for a non-owner-occupied income property. I'll get back to the 5% mortgage rate shortly. Also, the way you make money with this is think about it as a long-term ownership focus with these build-to-rents, generating revenue over time rather than immediately. Tenants get this house-like feel. They don't move very much. You can expect 3+ years average tenancy duration in most of these communities. Management fees are low for you, and that's because all the houses are the same, and they're all in the same area as well. Build-to-rent purchase prices are higher than retail property. You will pay more. You can expect better appreciation than resale property. And the rent range is often $1,500 to $3,500 a month. You can expect low maintenance on the property because it is brand new. And another thing that you get that you don't get with resale property is oftentimes with these build-to-rents, you get a builder home warranty, which really pushes down your maintenance or repair cost even more. So there are a ton of factors that give build-to-rent investor appeal. And now let me get back to those 5% mortgage rates. Yes, here at GRE, we can introduce you to some build-to-rent home builders that will buy your rate down for you prior to you purchasing. We even have one builder that is lowering the rate to 4.25% today. Others are in the high fives. And I really encourage you to get that incentive now, because when mortgage rates fall substantially sometime in the future, I do not expect these national home builders and regional home builders to keep giving you these rate buy downs. And yeah, sorry, J-Pal, this kind of makes your next Fed rate decision seem pretty irrelevant. So it's a great rental model to pursue and an amazing time to do it with the rate buy downs. And you know, I wish that build-to-rent would have existed when I began as an investor. You really didn't start hearing about BTR at all until about 10 years ago. Now, I appear as a guest on other business and investing shows throughout the week from time to time, and quite a few times the host asks me where the real estate investing opportunity is today. Like, where's the specific strategy? Where do you get in to be profitable? And the answer that I've been giving is that it's with build-to-rent properties and these rate buy downs. It occurred to me the other day, I haven't said that on this show in quite a while, so I wanted to share that with you. I mean, an income-producing asset, that is like your employee that's working for you, but it comes without the personality problems. And the property never calls in sick either. The property is also working for you 24/7. It doesn't ask for vacations. The property doesn't get paid holidays. An income-producing asset is like your perfect employee. working 24/7, overworked. Besides just helping you find the best build-to-rent deals today, what we can do here is help set up an entire real estate investment portfolio plan for you when we learn your goals. We can help build an income-producing real estate portfolio for you with our free coaching, and it's truly free. Now, if you're new here, you might think, oh, maybe we're trying to sell you something, and we are not. The way it works elsewhere is that some people get attracted to some sort of free offer, and then once you're on the phone or you're on Zoom or you went to some free live in-person event, they're going to try to sell you their better paid coaching or some online course for a fee. We don't even sell coaching or sell a course. If you wanted to buy something, we don't have it. This is free, no strings, no upsell, no catch coaching. All right, it's sort of the opposite of your automobile dealer calling you about your extended warranty, an overpriced item that you don't want. If you want to buy something from GRE, I mean, you can't even do it because we don't have anything to sell you. We're here to help. And by the way, I have no problem with companies selling paid courses or paid coaching, none at all. Some courses are worth paying for. It's just not what we do or have ever done here. But see, buying real estate, as remarkable as it is, real estate that you own directly, it's still not as simple as just finding a keyboard and pressing Control-Alt-Deal. So that's why our investment coaches help you learn your goals and then navigate the process. And then you want to keep in touch with your coach because the best deals are often changing. For example, you might think that you want to buy income property in, just say Alabama because its prices haven't run up as much as they have in, say, Florida. But here at GRE, we keep regular lines of communication open with build-to-rent home builders nationwide and say that there's a new community in Florida where the real deals are going to be in the next few months. So although you still like Alabama, you like how Florida is growing faster, so you end up there because of the new, say, build-to-rent community. Or there's better cash flow with some burst strategy properties, say, in Ohio that we have your coach inform you about. So I encourage you, get and maintain a line of communication with your GRE investment coach. To review what you learned today, leverage is the most powerful wealth creator. Home prices go up for reasons other than inflation. You can make the case that homes are not overpriced today. Home prices aren't up. The dollar is down. No one knows the future, but there is ample room for more home price growth. Build-to-rent property keeps increasing in popularity, and investors can get mortgage rates on them as low as about 5%. To contact an investment coach, it's free. Start at gremarketplace.com. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.